Hello and welcome to the first in our series of live, absolutely free your money and your life at Webcast. Today we've got a whole hour to help you regain control of your personal finances and get set up for the new financial year ahead. Now we've got a fantastic lineup of some of the best finance and property brains in the country ready to take your questions. So get them ready, start sending them in. Now this couldn't be easier. If you've got any questions, all you have to do is post them in the box below me right now and throughout our session for your chance to have them answered. And don't forget, you can watch today's session again here at any time you like. So let's kick it off. Let's get down to business with meeting our panel. First up, we have Gemma Dale, a regular expert on our small business TV show, Kochie's Business Builders. Gemma heads up the technical services division at MLC and leads a team of technical specialists providing support to over 2,000 financial advisors. Gemma's got 15 years experience in the financial services industry. She started obviously when she was 15. Gemma is particularly specialised in the areas of superannuation, tax, social security and general financial planning. Next up, Brenton Tong. Brenton has 15 years as an advisor specialising in wealth creation, particularly in designing strategies for both professionals and businesses to help them create wealth and build prosperity. As the head of strategy at Financial Spectrum, Brenton works with individuals day in, day out to help them get on top of their finances and accumulate wealth. And last but certainly not least, an old mate of mine, Louis Christopher. Louis is one of Australia's most recognised and respected property analysts. He's a regular on Sunrise. He's the founder of the independent property data and forecasting research house, SQM Research, which specialises in providing accurate, unbiased, property-related advice, research and data to developers, to real estate investors and financial institutions. Guys, welcome. Good to see you. Thank you for joining us. Look, let's start with a bit of a snapshot of the economy. The most common question I get asked is on interest rates. Where are they going? Brenton, do you want to have a go at that? Have we got any more reductions in line?
Look, there is the possibility of another rate cut. The thing which I always find interesting with rate cuts is people get really, really excited when interest rates fall, because obviously it means they're going to be spending a little less on their mortgage and put a little bit more money in their pocket. But the reality is when rates fall, it means the economy is actually not doing that well. It means retail spending's down a little bit. There's a little bit more pressure on businesses and with growth. So it's really, you want to moderate the excitement of getting a rate cut with the reality that means things are actually slowing down. We're seeing in the economy there's a lot of pressure in a lot of different areas, so there is the possibility of rates actually coming down a little bit. However, some of the stimulus which is coming out, falling the exchange rate as well, which is making some of our exports a little bit more cost effective in the international markets. Hopefully some of that will start flowing through, and there's the possibility of a little bit more on the downside for interest rates, but I wouldn't see things going down much further.
So we're getting close. No one can pick the bottom, but the chances are we're getting close to the bottom of the interest rate cycle.
It looks like we are at the moment. There is the possibility if we see China collapse or the US go into a major recession or the whole world just ending as we know it, rates could fall a little bit further, but in reality things seem to be relatively stable at the moment.
And Louis, that's the issue, is that no one can predict where interest rates are going, but the elements that affect interest rates you can watch out for, can't you? Sort of, as Brenton was saying, if the US collapses, at the moment it's, solid growth, not spectacular, but it seems as though it's getting out of the doldrums. China's stabilising, Europe's still a cock case. If it falls apart, well then rates might drop again. But if none of those happen, well, we're getting close to the bottom.
Oh, absolutely. And many people ask me, is there going to be a housing crash? Is there going to be a housing boom? I always put it to them, well, let's have a look at what would trigger such events, and are those triggers there with us now? So it's in a forecasting game, it is very difficult. No one knows the future. There's many X factors. When it comes to interest rates and perhaps looking at property, we know the Reserve Bank of Australia does have a very close eye on the property market. Yep. And I think if they were to look at the property market right now with a view of setting interest rates towards that, there's a little bit more work to be done. We are having a recovery, but it's certainly weak in a number of areas, with Sydney only being the one city recording real strong capital growth.
Okay.
So, certainly there's nothing there for the Reserve Bank of Australia to worry about in terms of creating a housing bubble. I'm not seeing any housing bubble at this point in time.
Yeah. What about all those people? Because I read all these reports from overseas saying, compared with the rest of the world, the Australian property market is just so overpriced.
Yeah.
There's got to be a collapse coming.
Well, the thing is with these people, I think they struggle to really understand our economy, what drives it. And yes, it's been easy to predict a housing crash in this country, but what the housing bears, shall we call them, have underestimated is the power and the resolve of the federal government and the Reserve Bank of Australia to actually stop such a crash.
Yeah.
You may recall some years back, back in 2008, when we were talking about the real possibility of a major correction then, and that was back in October 2008. Well, sure enough, the powers that be acted very quickly. They aggressively cut rates, they brought in first homeowner grants, they did everything to stop a housing crash.
Yeah.
And I think we should never underestimate that type of resolve.
Yeah, exactly, because it's just so important to confidence in consumers. Like, if you're an American and you've seen your house price drop 30%, you're not going to go out and buy anything at the shops or be optimistic at all. And also, the housing construction industry has a big ripple effect. It hires people, it buys stock. When a new home comes on the market, you got to go to the stores and buy your curtains and your new fridges, so it has a big ripple effect. It's really important. All right, we'll get back to a few more issues shortly, but let's get straight in to your questions, and don't forget, send them in the box down here. We'll get through as many as we possibly can. Anne Stevenson says, can the panel give us an indication of how they see international shares going over the next quarter or so? And let me get my crystal ball out. Let's polish it up. Brenton, give us an answer.
You're absolutely spot on. So my ball says no one actually has any idea what's going to happen. But international shares the Australian market's actually tiny in comparison. So when you do look at international shares, we're talking about where the bulk of the globe's money actually is. Yeah. And when you look at the globe, and you gave us a quick tour around the world, you've got the US, which is slowly recovering. Yeah. Sentiment is driving the market very much at the moment. So people are desperate for any kind of news, but they're going to react very, very quickly as a result of it. So stimulus is going to be very, very important. What's happening in China is going to be very important. Europe is probably a little less important because everyone is just expecting some sort of a disaster there. Yeah. I guess the broader effects of Europe are probably not as great unless you're actually investing into Europe. But it's a bit volatile at the moment. There's obviously the talk of shadow banking in China, and defaults are going up, and there's a lot of questions around how China's actually operating at the moment.
Because I always say you can do one of three things in the share market: you can buy, you can sell, or you can sit on the sidelines and do nothing and just watch what's happening. There is a time, isn't there, when there are just so many uncertainties that you might as well just sit there and wait to see if there's a trend emerge.
Well, I mean,
this time?
That's what I'm doing with my money, and that's what we're doing with a lot of our clients' money, and the fact that if you're going to try to predict what's going to happen, you've got, if you're lucky, a 50-50 chance of actually getting it right. On the balance of averages, you're more likely to get it wrong than you are to actually get it right. The world is in recovery mode. Things are happening, there is stimulus, people are slowly feeling a little bit better. If you just sit there and you wait for long enough, the world will slowly improve, and all the little ups and downs as to what's going to happen in the next quarter, even the next year or two, will just slowly become a distant memory. And I think eventually the world's going to right itself, and then you're going to be sitting in a good position.
Yeah, for my money at the moment, international shares are determined by the profit season in America at the moment. They're in the middle of it. If the big American companies are producing better than expected profits, that's good for international shares. Also, what the Federal Reserve, America's equivalent of the Reserve Bank, this bloke called Ben Bernanke, who's the boss of the Federal Reserve, if he says, okay, we're going to have a major change of tack in the way we stimulate the economy, that can be very unsettling for international shares. But as Brenton was saying, it's a really uncertain period at the moment, so sometimes better just to stay on the sidelines. Ruin Vandermeer, I hope I've got that correct, Ruin, wants to know, Gemma, is debt consolidation a wise thing to do?
So the first question is probably how much debt do you have and where is it?
Yep.
So debt consolidation applies where you have multiple debts.
Yeah.
with
So a few
multiple-
credit cards, a few personal loans, a mortgage, all that
Exactly.
sort of stuff.
And you have multiple interest rates. Because if they're all the same interest rate and they're all the same fee level, then frankly,
Yeah.
it's more a question of administration than anything else. It'd be nice to just have less hassle. But if you do have different interest rates, and it usually happens that you have a mortgage with a relatively low rate
Yeah.
and you have a credit card with nearly 20%, for example,
Yeah.
taking that debt and rolling it into your mortgage and paying 5% on it rather than 20 is quite an attractive option.
Yep.
Critical point is, though, you've got to keep paying it down.
Yep.
So don't consolidate and then pay the bare minimum and wonder why it doesn't go anywhere.
Yep.
So it's a really good strategy if you can ensure that you're using the right debt to consolidate it into
So
and you're paying it down.
right, that's the key, isn't it? Because if you say you're paying 20% on your credit card and you say, wacko, 5% is a lot less, but you leave that amount in for 20 years in your home loan, it's going to destroy you. But if you say, oh, I've got this 5,000 credit card debt, I'm going to stick it in the mortgage at 5%, but I'm going to make sure I'm going to pay that 5,000 down in a year or 6 months, then it's worthwhile.
Absolutely.
All right, so that's the key to it. It's otherwise you're going to still get yourself into this big debt trap. Michelle Hogan says, my husband and I can't decide whether it's best to pay out a $30,000 car loan to cut down on interest and start saving for a house deposit. Do you see house prices increasing by more than 10 to 20% in the next 2 years? Louis, Christopher, give us the great news. 10 to 20%.
Well, gee, that would be nice, wouldn't it? Look, it really does depend where Michelle lives. Okay,
Right.
so in Sydney, that's the city we're most bullish on, and in terms of this recovery, I want to rule out getting a total 30 to 40% gain for this cycle. It could actually be more, but
30
it's
to
really
40% in Sydney.
yeah. That I'm talking about over the course of the cycle, so
How long
not
is that
over the next
cycle?
2 years.
Right.
Okay, so right now we're getting capital growth in Sydney at an annualised basis of somewhere around 8 to 12%.
Right.
That's what we're getting now. Elsewhere, though, across the country, it really is horses for courses. So, for example, in Canberra, well, house prices are falling in Canberra right now, and we don't see that downturn really finishing anytime soon. We're really expecting, whoever the federal government is going to be, we're expecting a period where they're going to be doing a lot of slashing and burning, a lot of cutting of expenditures, and that actually affects that ACT market quite dramatically, and we're already seeing it now. On the other hand, if we look at Perth, well, Perth has had a rather strong recovery, which started from 2011. We've seen capital growth now of about 25% from the trough. But we're starting to see a little bit of a slowdown in that city now, so we don't see a lot of capital growth going forward from this point.
Right.
Other cities, well,
Let's
yeah.
go around the ground. You've done
you know.
Canberra, Sydney and Perth. So Brisbane?
Yeah, Brisbane, a little bit like we were talking about Adelaide before. It's been treading water. There's a lot of stock in the market. Capital growth potential for the next 12 months, no more than 5%.
Okay. Adelaide?
Same. I put Brisbane and Adelaide in the same camp.
Melbourne?
Melbourne, a lot of stock in the market. There's a little bit more buy activity now, though. So I'm thinking 5 to 7% is quite a probability for the next 12 months.
Hobart?
Hobart, prices have been falling. They're still falling now. We're hoping that the market will just simply bottom out over the next 12 months.
Darwin?
Darwin's been in a strong capital growth phase. We're talking, in 1 year it did 15%. It's growing now at an annualised rate of about 8 to 9%, so it's slowed down a bit. A little bit more supply coming on. Look, still house price rises in the order of 5 to 7% for the next 12 months.
And what about my old mates on the Gold
On
Coast?
the Gold Coast,
which
yeah.
I've caught the real shellacking over the last
Yeah.
couple of years, how bad it was. But any sign that that's bottoming out?
Yeah, well, Kochie, what we covered off when we first talked about the Gold Coast was something that was already happening and bringing that attention to the marketplace, something that the locals, well, in terms of some real estate agents and some newspaper groups, were not really doing. But now the good news is that the Gold Coast does appear to be bottoming out. I still think there's a lot of properties there which still need to have a bit of a correction because vendors haven't still realised where the market's at. But the core market has been bottoming out. The lower Australian dollar is finally helping. And I think, for example, this coming summer, there'll be an increase in tourism activity, and that will help the local economy there on the Gold Coast.
No, that's interesting. That's good. Well, that gives you good around the grounds. You can't, as Lou was saying, give a generalised answer on residential property. It depends on where you're talking about, and even within say the Sydneys and the Melbournes and the Brisbanes, different areas and different price brackets. I think I was ready on the weekend that $1 to $1.5 million market in Sydney is quite strong.
Yes.
But the top end is still a bit weak.
Still weak, and that's really a bit of a reflection of the Sydney economy. The other side that's really strong right now, and it's happening in a number of cities, is the real affordable end of the market.
Right.
So in Sydney's west and southwest, we're seeing regions completely outperforming the rest of the city at this point in time.
Okay, all right. Before we get back to your questions, of course, July, it is tax time. It is getting tax in. Gemma, it's still early in the new financial year. Give us your top tax tips for those people doing their returns, and also what to do with the refund.
Nice if you get one, obviously.
Yeah, that's right.
So the most important thing, it's a lovely time of year because you do get to, and for some people not so lovely perhaps, but you get to look back at what you have achieved over the year, so what you spent, what you earned, any deductions that you may have. Some of us get a nasty shock when we go to the accountant or the tax agent and find out that we don't have the receipts we thought we had, that sort of thing. So it gives you a really good opportunity to review what you have. And then talk to your agent, really. Talk to your accountant or your tax agent. Say, where am I missing opportunities? So if you have property, for example, there'll be a whole list of things you could do to optimise your tax position in that situation. And they can give you advice about that. But starting that process in July, rather than 2 weeks before 30 June thinking, I'd like to maximise my deductions now, will definitely help you optimise through the year. So look at your superannuation and make sure that you're optimising your contributions there. It's one of the areas that is most concessionally taxed. Are you salary sacrificing? Make sure that you're not going to breach your cap, which is really important.
So only put in up to the level that is appropriate for your age.
Absolutely.
And don't forget to take in your 9% or 9.25% into that as well.
Absolutely. And for those who are over 60, you now have a higher cap, which is a very attractive option for some people. So that's worth reviewing. So ensuring that you're looking at super as one of the most tax effective vehicles out there. If you have property, obviously there's an opportunity to look at how you maximise your deductions in that situation. But never forget that you're only paying tax because you're earning something.
Yeah, exactly right. And that is a great reflection, isn't it? That you are making a profit. Tax office always says to me, when they have a dispute with the taxpayer, they win 95% of the time, not because of the tax law, but because the taxpayer doesn't have the records to back up their argument. So it's all about record keeping. Now, credit card transactions are seen as a receipt, aren't they? These days with tax. So, if you're a tradie, if you're somebody in your own home-based business, put all the deductible expenses on your credit card because that's your record keeping.
At the minimum, you've got something to show, which is fantastic. So when you get to the end of the year, it's not a complete crisis. And also, they're all online, generally with your bank, so you can go back and find the records even if you didn't file them away.
That's probably the biggest tip. Let's go to another question. And Mark says, for a first-time investor, what would be the best strategy to ensure a good return for year-end? All right, so you're a first-time investor. Brenton, how do you get your leg in? There is the what's best, shares or property? I suppose that's the first question. And for a first timer, what's the best introduction to investing?
Okay, well, investing is very much horses for courses, so everyone's going to be a little bit different. So the debate of shares versus property is current. It's been around for a very long time, and it's never actually going to get solved. The reason being is some people can make more money out of property than others, and some people will make more out of the share market. And it really comes down to where your starting point is and also what you're trying to achieve as well. But probably the most important thing to get your head around if you are a first-time investor and you're trying to work out what you should be doing is the time frame you've actually got. So when you're investing into any type of growth investment, the amount of time you're investing into it is really going to make a very big difference to the type of risks you're taking and the reward or the the return you're going to get at the end. So a very simple example is if you bought a house today and you sold that in 50 years' time, most people would say you're virtually guaranteed of making a profit. But if you sold that same house in 6 months' time, no one's going to be able to tell you whether or not your sale price is going to be above or below what you've actually paid for it. So the only thing you've changed there is the time frame.
Yep.
And you've taken the same asset and made it very risky or very, very safe. So as a first-time investor, if you're looking to put your money away for, say, 6 months and get a really good return, then, if you're not scared of losing money, given the entry and the exit prices, then the stock market could potentially work for you. But you have to be prepared and have the resolve that in 6 months' time, the stock market could be 5, 10, 15, 20% below where it is at the moment.
Yeah.
If you're not prepared to weather that risk, you have to look at something which is a little lower risk, and then you're reverting back to the cash market, which for
Term
most people,
deposits or
term
savings
deposits,
account,
online
accounts.
savings accounts. I mean, as of this morning, I think the best online savings account was 4.76%,
Yep.
which is not an amount of money or not an amount of return which is going to change your financial future, but it certainly is allowing you to keep up with inflation.
Yep.
And you're guaranteed not to lose any money over that period of time.
For first-time investors, though, a couple of things: always buy quality. Don't buy dodgy tips from the back neighbour who's got a nephew that's a geologist with some dodgy mining company in WA. So stick with quality and what you know. But managed funds are good step for first-time investors. That you put your money in one of these funds. It's professionally managed, and you get a sense of maybe how a manager looks after money.
It certainly can be a good way of investing, especially if you've got smaller amounts of money.
Yep.
The dodgy tip pops up everywhere, and try to avoid it as much as possible. But if you are looking at investing into the stock market, you do want to spread your risk over a few different areas. And if you've only got a small amount of money, things like brokerage fees will just eat your money alive. If you buy one stock and you pay $20 as a fee, that's not too much. But if you want to buy 30 or 40 shares, then the fees are going to really add up. So that's where managed funds actually can become a much better way of investing for investors who have either a smaller amount of money, or for those investors who really don't want the day-to-day management. The differences between different funds, there is an enormous amount of difference between all the different fund managers. A lot of them do something different. A lot of them do the exact same thing, but they do it in a slightly different colour. So all the brochures will be telling all the virtues of all the great things which they do, but ultimately a lot of them are actually very, very similar. But again, it comes down to what you're trying to achieve in the longer term.
And if it's really long term, maybe you just look at contributing more to your superannuation, salary sacrificing that up to your limits, because it's going into an investment fund, depending on the option you're with, that is in shares and property and fixed interest and the like. Could be the easiest way. Let's talk to Ingrid. I'm looking to buy my first house in the next 3 years. I have my house deposit, but I don't know where I should be keeping my money. Should I leave it in the bank and get the interest, or invest it somewhere? What do you reckon, Louis?
Yeah, I thought this would go to me. Look, it really does boil down to their own personal financial circumstances. I think the poster was from Sydney. Okay. So yes, well, our forecast is that Sydney will outperform the other capital cities for the next 12 months, as we've just previously discussed. And I do believe the returns will be greater than leaving the money in the cash. I'd just like to pick up maybe on the previous question as well, that look at, especially with property, there's actually really high transaction costs involved. When you're buying and selling, there's at least 8% of the property's value. So it really makes it difficult.
So what's that? That's your legal fees,
your
and
stamp duty, agents' fees, advertising, all that. And it just makes it really difficult to buy and sell at a profit on property over a short term. It really is a longer term investment.
So what's the minimum you should invest in property for? If you're looking at investing in a property, what's the minimum you should give it to get over that?
I guess I can only take it at my own personal level. When I'm looking at areas personally to invest in, I'm taking a 10-year view.
Okay.
But that's just me.
Right.
But I generally look at a view that I want to hold this for 10 years. I've had a lot of experience in property selling from a very early age. I bought my first commercial property when I was 23. That's the reason why I don't have so much up here, Kochie, I guarantee you. It's been a stressful affair, but I've learned a lot. And one thing I've definitely learned is that short-term flipping is not reality. It doesn't work. And I must say...
Hang on, you hear all these people boast about it in the pub, or mates that say, doubled this in
Yeah.
3 years. I must say, it's never happened to me.
No.
But so many people sort
Yeah.
of inflate, I tend to think, some of the
They
the
do,
returns they
and
get.
don't even get me started about renovation shows as well, Kochie. Okay?
Okay, well, after the block last night, everyone's into this sort of stuff.
They are, and I've written a lot about this. Look, these shows, sadly, don't take into account home trips.
Right.
For example, when they work out their profit, they don't take into account what the interest expense will be,
Yep.
or the stamp duty, all those transaction costs I've talked about. It actually makes renovating for profit a very difficult affair, and the only people I know who have made it work are people who, for example, they're a specialist, like they might be a carpenter.
Right.
They're able to do something
So you
themselves,
bring a
I
skill.
suppose. They bring a skill. That's the only time I've known people to make a profit, unless the market's absolutely galloping ahead, of which case I would have been making a profit anyway.
Yep, okay. That's wise advice. Richard Jordan sends in this question. Gemma, I'll retire in 2 years. I'll switch my super to cash to avoid any downturn before then. Is that the right move?
So it's a difficult question. It's the right move if you genuinely don't want to take any risk.
Right.
So if you, and this happens for many people, you go, I categorically will not wear any loss at all between now and that 2 year time frame when I retire.
Yep.
And obviously there'd be a number of people in 2006, 2007 who wish they made that decision.
Yep.
By the same token, 2 years, things may not go to hell, they may do quite nicely. And you do have a long time in retirement. So it's not just about that date that you leave work. It's about the 20 or 30 years you have after that,
Right.
that you need to live on this money. So if you can't wear any risk for that whole 30-year time frame, to the point that was made earlier, inflation's going to be eating away at this money the whole time.
Yep.
Getting a return of only 3, 4, 5% because it's in cash could be really disadvantageous to you. So my suggestion would be have a chat with a financial planner or someone who can talk you through the levels of risk
Yep.
you might be willing to take.
Because you've got all these boxes, okay,
Yeah.
and this is the big thing
Yeah.
that I reckon the biggest mistake people have in super, and I've spoken to a number of mates of mine and people at Channel 7 say, I've been crucified on my super, and you go, well, what option are you in? What do you mean? You say, well, there's probably 15 to 20 depending on your fund. Bring in your statement,
Yeah.
and they're invariably in high risk
Aggressive
international
growth.
aggressive growth or international shares or something. So flip over your statement and you've got all the boxes there you can switch between. So if you're approaching to retirement, what sort of options should you be looking at? Maybe, we've heard the pure cash one
Yes.
has its disadvantage, but what others are there?
So if you're in a fairly standard public offer type fund, so a
Yep.
fairly standard fund, they'll probably give you 5 options at the minimum. They'll have a cash option, which
Yep.
is, as you say, very basic. There'll be a defensive option or a conservative option, and that will take considerably less risk than the more aggressive portfolios.
But we'll still have a bit of shares, bit of
We'll
property.
have a little bit of
things
shares, a little bit of property, but it'll be 5, 10, 15%. It won't be 70%.
Yeah.
There'll be a moderate or a balanced option. So they always, when they say super's done this, use the balanced option.
Right, yeah.
Super's done all sorts of stuff. Super's gone everywhere because you can invest in anything you like pretty much.
Yeah.
So there's no standard super return,
Yeah.
but they will use a balanced option to be reflective of what superannuation has done because that's where most people are invested by default. And that will have a balance of 60-40 growth assets versus defensive assets, or 70-30. And then as you move up the spectrum, the more aggressive options, and then you can get options that are effectively just international and Australian equities with perhaps a bit of property.
Right, okay.
So as you say, if you're in that option, you better be comfortable with a lot of risk.
Yeah, exactly. So, I can quite understand that all of a sudden you don't want to lose everything just before retirement. But as Gemma was saying, sort of super retirement now isn't you retire and you get all the money out of super. It actually stays there. So you've got to look a bit further on, don't you, to make sure it works for you.
Yeah.
Okay. All right, let's take another question. And Susie is talking, how do you make a family budget work effectively when you're paid monthly? Susie, you've got to put the work in. You've got to do your household budget. You've got to monitor it. You've got to make sure that your spending is in line. I've come across a terrific app that is an online website now called Pocketbook, and by a young bunch of Australians, blokes that we've been helping to develop, and it aggregates all your credit card and bank accounts and then classifies them all into a family budget and measures it against the budget you've set yourself, and sends you little text messages saying, oh, you know, your entertainment's your monthly entertainment budget is about to be breached or whatever. So there's lots of technology to keep around, isn't there, Gemma, to actually keep your your personal finances under control.
Look, we're really privileged these days. You know, it's not sitting there writing it out by hand and trying to calculate it. As you say, there's extraordinary opportunities from a technology perspective to have it really managed for you.
Yeah.
I personally like to break it down to a time frame that you're really comfortable with. So
Yeah.
getting paid monthly is just that bit harder than getting paid fortnightly or weekly.
Yeah.
If you're more comfortable with fortnightly or weekly, use that.
Yeah.
You're really only dividing by a very simple number.
Yeah.
And so if you can break it down to, well, my weekly budget is such and such, I have this much for groceries, I'm likely to have all of these other expenses, and the technology will do it for you,
Yep.
then that might be an easier way to do it, rather than thinking I get this lump sum once a month and I have no idea whether it's going to be too
Enough.
much or too little.
Yeah, yeah. Really good tip for parents who have teenage kids. When they turn teenagers, pay their pocket money monthly rather than weekly or fortnightly. Give it to them monthly, and then it starts to teach them how to budget over a longer period. And they get into strife the first couple of months, but then they effectively get the hang of it, and it's a great life skill. Don't forget, if you want to put a question to any of our panel, just stick it in the bottom box here. Steve says, is there any such thing as a Big Four bank rewarding you for loyal customers in terms of home loans? Is there any benefit in staying with your current bank if you're looking to get a home loan in the next year or so? Brendan, there's a whole range of financiers open to you, isn't there?
There is the home loan market is very, very competitive at the moment. And I remember when my parents were doing their banking, they'd actually know some of the staff in their branch, and they were looked after relatively well. But what it appears to be at the moment is that the banks seem to be chasing new business probably more than actually looking after some of the stuff they've got at the moment.
Right.
So what we're finding works quite well for some of our clients when we're trying to help them to negotiate with their bank is actually look outside of your bank, see what what banks are looking to offer you, and then take that back to your existing bank and see if they'll match it. The government's made some changes to try to make swapping from one bank to the other a lot easier. They haven't worked that well, and a lot of people are still staying with their existing bank because, quite frankly, doing the application forms, getting the valuation, getting your pay slips together and all the documentation is still a fair bit of work for a lot of people.
Yep.
So if you can go out there, find out what people are willing to do just to get your business, and then take that back to your existing bank, you've probably got a 50-50 chance that your existing bank will then turn around and say, fine, we'll match it just to keep you.
Right.
But there's probably a 50-50 chance they're going to turn around and say, I'm sorry, we're not going to do that, which
Right.
means you're going to have to go through the paperwork and swap over.
Right. And a couple of things to convince your bank what a good customer you are. Like, if you've got your insurances with the bank, if you've got your credit cards with the bank, you're a good customer, aren't you?
You are.
And the more you can show that, the more likely they are to give you a deal.
Well, part of the bank's growth strategy is they're bit by bit they're buying out more and more of both their direct competitors and also their vertically integrated competitors. So most of the big banks these days have got insurance, they've got financial planning, they've got funds management and superannuation. They've got pretty much everything you can put your money into. So with that regard, if you want to really keep everything in the one space because it's more convenient, reminding your bank of that certainly can be very, very useful.
Yeah. And, there's the old saying, you're a mug if you're paying the advertised rate on your home loan. At least go to your bank manager and give it a go. Just say, hey, can you give me a discount? And more often than not, Natalie Barr, who does reads the news on Sunrise, she put it to the test because she didn't believe me. Who would have thought? She'd go, I can't believe you can do that. Went to her bank manager, said, can I get a discount? And the manager said, yes. She said, well, why? Well, because you're a good customer. And she said, why did I have to come and ask you for the discount? And he said, well, we're just not going to offer it to you. You know, if you come and ask, we'll try and do the best deal, but it's up to us to do it. So give it a go. They can only say no, and you might get a quarter, maybe 0.5%.
Maybe.
Cut off your home loan. So give it a go. That's probably your best step for it. All right, don't forget, put your questions in the box down below. Louis, in terms of tax, when you've got a property investment,
Yeah.
what are some of the things you should be looking out for? What are the biggest mistakes property investors make in terms of tax?
I think the biggest mistake is overestimating the benefits of negative gearing.
Right.
Okay, so everyone's heard of negative gearing. Some people don't understand what it really is. It is certainly a tax benefit where basically the loss you create on your property can be deducted off your personal income or off your wage and brings down your overall tax exposure.
Yep.
But people must remember in this that a loss is a loss in many respects, right? And for residential property, which is yielding now at about 4% gross, okay, it's actually really hard in this market to find a positive cash flow property in residential. It's possible if you go to, for example, mining towns, but I digress a bit. We're talking about tax. Negative gearing is definitely the clear benefit, but people should be aware of, for example, you can get depreciation benefits off especially new property. So you can certainly get certain appreciation benefits. If I recall, it's about 2.5%. And then, of course, there is capital gains tax, which applies on investment property, but doesn't apply on your principal place of residence. Overall, the taxation benefits towards real estate are actually quite positive. There's no doubt about that. And then you've got other benefits as well, as, for example, we've had first home buyer grants, and right now, especially if you buy a new home, there's quite a lot of grants. In New South Wales, for example, the rebate, the total concessions are actually worth $35,000.
Yep.
So, yeah, there's various benefits with property, but I always stress that shouldn't be the sole reason why you go and buy a property.
Right. Because that's always been a selling point in the past, hasn't it? Invest in property, negatively gear it, get the tax man to pay half of your interest,
Yes.
and then it's a fail-safe. Doesn't really stack up unless you're in the very top tax bracket and you can afford the negative. The negative means
Yep.
you're going to have to put cash in during the year, and you're going to have to wait for your tax return to balance the books.
Absolutely. I mean, look, the reality is, of course, is we have had good capital gains in property. So if you look on a total return perspective, it's been good. Investors have certainly gained. Investors, though, should be aware it's actually very, very difficult, though, to get a positive cash flow out of residential property, especially in the first few years.
Okay, all right. Getting a lot of questions on superannuation. Gemma coming through saying, what are the things to look out for when choosing a fund? Do you automatically get what your employer says you've got to stick your money in here, or is there a choice?
So you have a choice. For the last 5, 6, 7 years, you've been able to choose your own fund. It's not necessarily just when you go to a new employer, but that's obviously a catalyst for a lot of people. So they give you a form. There's a standard choice form that you can use to go and choose a different fund. The question is, do you want to?
Yep.
So a lot of employers will negotiate fantastic packages with a corporate super fund or an industry fund that gives you a whole variety of things, very good fees, very competitive, really good insurance and so on. So you do want to look closely at the employer fund offered to you and check whether that might meet all your needs.
Right, okay.
And often the insurance pricing can be very appealing, particularly if you're younger.
Yep.
So having a look at that and seeing if that does meet your needs, then you don't necessarily need to exercise that choice.
Yep. What about performance and things like that? How do you assess that in a fund? How do you know if that fund's giving you a return that's not, way better than anybody else, but isn't a lot less than compared? Yeah.
So to the point we were making earlier, the first thing is understand what your investment choices are.
Yep.
So you could say my return was atrocious if you were in shares during a very, very aggressive down market. Relative to cash, and that's fair enough, that would be absolutely true. It doesn't necessarily mean that particular fund manager is worse than another fund manager. They just happen to be in an asset class that didn't do very well during that period.
Yeah. And,
So
and all managers in that class didn't do very well.
they would have all
Yeah.
done badly. So ensure that you're comparing like with like.
Yeah.
Compare Australian equity fund managers with Australian equity fund managers, and cash with cash, for example. Have a look at the fees. It's probably the first thing. So the fees will have an enormous impact on what your overall return is.
Okay.
If
So
someone's
what's a
taking
good fee to pay? What's a good average fee to pay? Is there a benchmark?
Look, it depends on what you're getting for the fee, but if you can get something around the 1% mark, then you don't need to be too upset. But also, you don't want to pay an enormous fee for cash, because that's not very complicated to manage.
Yeah.
You should be willing to pay a higher fee for something that's quite complex, for
Right.
example,
Yeah.
and
So,
difficult to
so
manage,
good rule of thumb, 1%.
depending on what you're in.
Okay, all right. Okay, what's the minimum that balance to start my own self-managed super fund? They seem to be the go at the moment. Brenton, first of all, who should consider a self-managed super fund?
Well, there's a lot of people who will who'll set 150, 200, 300, 400. So there's a lot of rules out there, and they're all quite confusing. And the first thing about a self-managed super fund, it is a self-managed fund. So you're going to want to actually do this thing yourself. There's a lot of retail funds out there which will allow you to buy any share, invest into term deposits, do pretty much anything you want. So there's a lot of compelling reasons to actually not do it. But if you want to run the fund yourself, then you have to look at what it is you're actually trying to achieve. So if you want to invest into something which you can't invest into, such as real estate, or if you actually want to go and physically buy gold or diamonds or something like that, you can't do that with a retail fund. You have to go to a self-managed fund. Then you have to look at what's it going to cost me. Now, a self-managed fund's going to cost you anywhere from $1 to probably $3 or $4 a year to run, depending on who's actually going to do it for you. So thinking, well, if you've got $50,000, it's going to cost you $4,000 per year to run. That's 8% per year.
Yep.
You're going to have to get a really, really good return to actually make that back.
Yep.
But if you've got $1 million in your super and you're looking at just looking at some term deposits, it might cost you $1 or $2 to run $1 million self-managed super fund. That's well below the 1% benchmark that we were talking about just a second ago.
Right.
So even if you're just going to plonk it in a term deposit, that could be worthwhile for you. So different people are going to have different situations which are going to lead to whether or not you should be doing it.
Yep. Gemma, is it that, and the type of person, as Brendan was saying, you've got to want to be involved because you've got to have the
Absolutely.
skills to do it and the patience to do it. It's got to be audited every year. As a trustee, it comes with a lot of obligations. And it's mainly professionals and small business owners that look at this area.
Yeah, we largely see executives and professional types, definitely small business owners. They love it. They like to be in control of their business. You like to be in control of your super as well.
Yeah.
If I have to pay this money there, I'm going to look after it myself. But it's quite interesting to watch the demographics changing. A lot of retirees are very interested in this area.
Why?
Because you have time on your hands and this money has to last you for the rest of your life.
Right.
So all of that administrative burden, when you're not working 40, 50, 60 hours a week, suddenly doesn't seem like such a burden. And also, a lot of people take it up as a hobby. They love investing, love talking about the property or the shares or whatever it might be. So we're seeing a really strong growth in that group of people who really, really love it. Don't see it as a burden at all.
Yeah. So very much an individual choice, how active you want to be in the future. Another question, how do apartments compare to houses as an investment, Louis?
Yeah, look, an age-old question once again. The truth is when you look at the performance over the long term, taking into account all types of costs, including maintenance costs, because they are different between houses and units, the returns equate. They run equal with each other.
Oh, okay.
If you same location, they generally run in line with each other. So I strongly, when I get this question, I throw rhetorical questions right back at the person asking, like, what are your financial circumstances? How much have you got to spend? What type of tolerance have you got for maintenance? These things really affect the decision. So generally speaking, units are a little bit more lower maintenance than houses, but they come with their own issues such as strata issues. There's pros and cons to both, but when you strictly look at performance in terms of returns, they equate with each other over the long term.
And I suppose if you're an investor, you've got to also ask yourself not what the potential is for investment return, but do I want to be a landlord? Like, being a landlord isn't all it's cracked up to be.
No
if
way.
you get a narky tenant, it can be a nightmare, Louis, can't it?
Kochie, my first experience with property was with my grandfather, where he was a landlord on a couple of properties, and I can tell you now, his life was a nightmare in many instances. He would turn up and I would see it firsthand, just rubbish all over the place in the property, tenant leaving the property, just badly managed, graffiti. I've seen it all. And it can be absolutely terrible, but it can also be rewarding too. There is a rewarding element to it when you try and improve the property, make it a better type of residence. But it is hard work. There's no question about it. There's a lot of maintenance. It's involved, a lot of your own time involved in looking after property.
Yeah. All right. While we've got you here, when should you buy a property through a trust?
When, or like through a self-managed super fund?
Yeah.
Well, I'm a perfect case study because I'm doing it right now. and maybe if I could share my experience so far. So what I'm actually doing is that I'm setting up a self-managed super fund to buy a commercial office, because I've been my business is renting in town an office suite, and I've done the numbers and I've worked out that buying a commercial office is far better off for my business. I'll save so much money in rent through doing it this way. And this is one of the things with self-managed super funds. If you're buying a residential property through a self-managed super fund, you can't live in that property, and you can't have any relatives living in that property. It's just got to be a pure investment. However, when it comes to commercial, there's a little bit of a loophole. If you're buying it via your business, you can actually have that business reside in that property and basically get deductions on both sides. So far the costs for me, the setup costs have been $1,800, but I know I'm going to save personally for my business about $50,000 a year in terms of the rent comparison versus occupying this property and paying the interest expense.
Okay, gee, that's interesting.
Yeah.
All right, there you go. Thank you for that. Alan says, when is it worthwhile to get an accountant to do your personal tax? Brenton?
I've got clients who actually have trust and company structures and incredibly complex affairs, and they actually do their tax themselves because they actually enjoy it. On the flip
That
side,
must be very strange people.
that's their world. They love that kind of stuff. But on the flip side, I've got clients who've got hardly any deductions whatsoever, and they just couldn't be bothered doing it. So there is an element of personal choice in there. On the balance of averages, you can get a tax return done really, really cheaply. The people who do it are quite well trained at what they do. The technology these days usually allows them just to jump online and put it straight in for you. And there's quite a few just standard deductions that you can actually get with regards to education, media, transport, uniforms, lots of different things which the average person may not actually be aware of. So providing that the accountant's actually providing with value to you, which is either equal to or in excess of what it's actually going to cost you. Throw on top of that someone else is going to handle your tax affairs, so you don't have to do it yourself. That's kind of how you should be thinking about it.
And also, I know I'm sounding a bit nerdy here, but one of the best websites you can go to is the tax office website, ato.gov.au. They have so much information for taxpayers there on deductions for different workplaces and different professions, good stuff on property and what's deductible and what's not. That you can't claim improvements, but you can, or you can't claim maintenance, but you can claim proper improvements to a property. So it's often a good starting place to go to, which is great.
Absolutely.
All right. Everyone also wants to know, Kathy wants to know, Gemma, limitations on investments with self-managed super funds.
So Louis mentioned a fantastic example of one before. The critical thing is it's something that governs all superannuation, but particularly self-managed super funds, because obviously it gets a little bit more dicey when you're running it yourself, called the sole purpose test. And what that says is, I am using this money for my retirement and for no other purpose. There's a couple of other purposes, in case you die and stuff. But basically it's saying this is a retirement savings vehicle. This is not about my acquiring an asset that I'd like to have on the side. And if I happen to buy the diamonds, this is not about buying the diamonds so I can wear the diamonds prior to said retirement. One of the few exemptions to that is business real property. So where you use property for business purposes or you lease it to a business, doesn't have to be your own. But if you go and buy an investment property, you can't acquire it from yourself.
That's
You
right.
can't acquire it from a relative. You can't acquire it from certain business associates. It really has to be acquired on market, at market rates. Pretty much everything has to be done at market rates. And then you can't have those people live in it. They can't go and have a little stay if it's a holiday home. There's a whole lot of limitations about ensuring that that money is there for your retirement and no other purpose.
All right, so you can't, if you fall in love with a vintage car, you can't buy it and stick it in your super fund and drive it on weekends. You can't
You can
whack
buy
your
it and stick it in
holiday.
your super fund, you just can't drive it.
Right.
Or put it in your garage.
Okay, so you can't, sort of the rule of thumb is that sort of stuff you can buy it as long as you don't enjoy it.
Pretty much.
That it's straight as an investment.
Which kind of defeats the purpose for a lot of people.
Yeah.
May
And-
I add something there too, that when it comes to residential property, one thing I forgot to mention before is that you can't get the negative gearing once you have a self-managed super fund. So you can claim deductions, but the loss that may occur on that trust, for example, you cannot claim that against your personal income.
So you can offset it exactly as you say against
Yeah.
income in the fund,
In
but
the
not
fund
against
only.
your personal income.
Exactly.
Which is really where you get the high tax brackets.
Yeah, and that's why buying, in my opinion, if you are looking to buy property for maybe tax deductions, you're still better off buying residential property, and I do speak of just residential here, in your personal name.
Unless it's positive gearing.
Yeah, unless
which,
it's
as
positive
you're saying, is not
gearing.
really happening at the moment anyway.
Yeah.
Yeah. Good question saying, where can people get more information on property markets, houses, patterns? I think this would be one of your staff probably sent this question in,
Yes.
because the amount of research that is available today is extraordinary, down to the history of an individual property in an individual street that you're interested in.
Absolutely, yeah. The expansion of information since I got involved in this industry is just remarkable. I mean, when I started off doing this, really the gatekeepers were like, for example, the real estate institutes. They held a lot of the data, but nowadays individuals can certainly easily get access to property sales data in their own street, get a full 10-year history. They can get online valuations, for example, via our own firm. The amount of information that's out there is just absolutely fantastic. Sometimes it gets a little bit confusing, and there's still debates now about whether house prices are rising or falling, because there's different index providers, my competitors, coming out saying different things. So it can still be very confusing. But we are almost at the point where there is too much information out there.
So if you're interested in a property though, you can get a report that says the existing owner bought this property for X amount 3 or 4 years ago, and the one before that paid X and the whole lot.
Absolutely, and you can, for example, get a full marketing history of how long that property's been on the market for. If you're looking at a particular property right now, whether the vendors have been discounting their property, you can get all that.
So all that information that just real estate agents used to have access to, we can get it now.
Absolutely.
Now, huge cost? What's it
Well,
cost? Say you do a single house appraisal.
Okay,
what would
so
that cost?
we've got a tool, for example, that allows you to do unlimited valuations on almost any residential property in the country. That costs $120 a month, and you can unsubscribe anytime you want.
Right.
That gives you all the property sales, it gives you a marketing history, it gives you the valuation which you can interact with. So yeah, that's there at your disposal. We also have another product which is called the Home Discounts Report, which gives that full marketing history of all properties within a postcode, how long they've been on the market for, how much the vendor's been discounting it from, and the last sale price of that property. So they have access to that as well. So pretty much anything you can think of that you've wanted to know a property, short of the reason why the vendor's selling, is available now.
When you're paying a couple of $100,000 for a property, and it might cost you $100 to get the complete history of that property and the area, it's a pretty good investment, isn't it?
Well, that's right.
To be fully informed.
Well, without giving our website too much of a plug, the cheapest product we've got is $9, which gives you the top 100 bargains in the country, most discounted properties in the country for $9. So
Okay.
it's
All
pretty
right.
cheap.
So it's all there. Go to the SQM website. What is it?
sqmresearch.com.au.
Yeah, it is. So make the most of it. Renting versus buying in this environment?
Well, at this point in time, I've seen reports that suggest that buying is cheaper than renting. I dispute many of those reports. For the major capital cities, it's still cheaper to rent versus buying, but I note that you should consider this over the long term.
Yeah.
I often think of property as being a great investment for those people who really struggle to save.
Yeah.
It's good for savings.
Yeah.
If you can save, then consider renting for a period of time. But bear in mind that the history has shown that rents do continue to rise at approximately the rate of nominal GDP year in, year out. So while it's cheaper for you now to rent versus, say, buying, in, say, 5 years' time, if you looked at the numbers then and you considered if you bought, then it starts working out in favour of buying in terms of being cheaper.
And I always say to people, hey, it might be better to rent than buy, and I can give you really good financial analysis on, from an investment point of view, better to rent than buy. But it's based on you having the discipline that the difference between what you're paying in rent and what you would pay in terms of a mortgage on that very same property, you must invest that difference rather than spend it.
Absolutely.
And that takes the discipline, because a lot of people are, it's cheaper, I'll go to an extra restaurant per month or whatever, and they'll just absorb it in day-to-day living expenses. If you're disciplined enough and say, hey, I'm going to put that gap into super as extra contributions, or go to a financial planner and set up a savings scheme, an investment scheme, well then that's terrific. That's a way to do it. If you can't do that, well then, as Louis was saying, it's probably better off buying and going into forced savings and paying down the mortgage and setting up a scheme like that. It's important to do it. All right, we're coming to the close of our time. Guys, a bit of a wrap up. Gemma, the best bit of investment advice that you give clients, what would it be? When you look at the history that you've been in and you say, okay, I wish everybody would follow this one bit of advice, because too many people make a mistake.
Take an interest.
Right.
It sounds so simple and frankly a bit embarrassing as a statement, but take an interest. We find the vast majority of people don't really take an interest until quite late in their financial situation, particularly as it relates to retirement, and then it's very difficult to achieve what you want to achieve.
Yeah.
So we know that time is your friend, exactly to the point made earlier, a 50-year time frame means you will almost definitely do well.
Yeah.
If you start early and you are thinking about what you're doing and you understand it well, you're vastly more likely to be okay than a person who's been burying their head in the sand and then panics at the end.
And don't be intimidated. It's really not that hard, is it? It's basically a lot of common sense. I always say to couples, spend 15 minutes a month just talking about your money together. I don't mean checking your bank statements and paying bills and things like that. I mean sitting down with a glass of red or whatever and just saying, how are we going financially? What are our goals? What do we want to save for? How are we going and keeping on top of things? And if we're not, what can we cut back? That sort of stuff. 15 minutes a month. Doesn't sound much, but I bet you don't do it now. Brenton?
Well, it's actually following on from a theme that you just mentioned then, which is setting a direction. And what I find is I meet a lot of people, and a lot of people come to our firm, and they don't actually know what they want to achieve. They have, it could be 10 years, it could be 40 years of work life ahead of them. They don't know they don't know where they want to live, they don't know what type of life they want for their children. And if you don't make some decisions and actually set some direction, you'll find for the next however many years, you're going to be bouncing from one idea to the next.
Yep.
You're not going to resolve what you want to do, you're not going to do it well. And what I find is, when people take losses from their investments, quite often it's because they've invested as if they're moving in this direction, whereas in fact they're actually going over here, and then they need to sell something at the wrong time. So it's really about actually working out what you want to do, when you want to do it, and building a really good strategy. Giving yourself enough room so you can wiggle left and right a little bit, but actually figure out where you want to go, and then just set the key milestones that you want to achieve to get there.
It's quite right. The most common question I get is just what should I do with X amount of dollars? And my immediate response is, what do you want it to do for you? Look at you and go, well, short term, long term, income, capital growth, exactly what Brenton is saying. You've actually got to decide yourself what you want your finances to do. In terms of property, Louis, what's the
so
big
many
fact?
tips, I guess, but the main one is don't overpay for a property.
Yep.
And to avoid not overpaying for a property, don't do things like for your first investment property, buy an off-the-plan development. Stick with something that's plain vanilla. If you want to work out how not to overpay for a property, to go and get yourself a valuation. If it's not from me, get it from somewhere else. That's really important. It's really important not to overpay, because otherwise that first experience is going to be a rather bad one.
Yeah, and that will affect you for the rest of your life,
Correct.
which is the thing. Guys, thank you very much for joining us. Really huge thanks to Louis, Brenton and Gemma for their time this afternoon. Thank you very much for that. That's all we had time for today. Great tips from the panel. Now, if you want to watch today's session again, just copy and paste the link to this registration page that you got here with. We'll be back with lots more webcasts in this series of Your Money in Your Life. So keep an eye on Facebook. We'll see you same time next Monday afternoon as well, 12:30 Eastern. In the meantime, think up any questions you may have, and we'll see you then.